In this week's video, we'll review the latest charts and data to help us answer the question, will a recession lead to a sharp reversal in stocks? Let's start with a quote from The Psychology of Money. But pessimism about money takes a different level of allure. Say we're nearing the next Great Depression and you'll get on TV. But mention that good times are ahead or markets have room to run, and a common reaction from commentators and spectators alike is that you're either a salesman or comically aloof of risks. We often say in these videos that we're trying to determine and assess the probability of good things happening relative to the probability of bad things happening. There are always a list of bad things happening. We have to remember and we have to be willing to offset that list with the list of good things that are happening. And data points like this tweet from April 14th can help us do that. Tweet, upper left-hand corner of your screen. It feels like too much too fast. The S&P has jumped 12.5% over the last 17 sessions. For many investors, instinct says sell, take profits, wait for a better entry point. But history says ignore that instinct. And of course, that concept and the table on the right side of your screen, all of it speaks to probabilities. Once again, the probability of good things happening relative to the probability of bad things happening. And we all know the probability of bad things happening is never zero. But as we go through the charts this week, think about the psychology of investors, because that's what drives markets. And think about basic economics and the law of supply and the law of demand. It's a daily anchored volume weighted average price chart of the NASDAQ composite dated May 1st. This chart helps us understand the relative conviction of the stock market bulls relative to the stock market bears. This is where the S&P 500 peaks here on January 3rd of 2022. You can see when the market tries to rally in this region here, the conviction of the bears is greater than the conviction of the bulls, and the blue lines act as resistance. Same in this region here in July of 2022. Then the conviction starts to shift in this area here, and rather than acting as resistance near the October 2023 low, all of these lines converge and act as support. And you can see on the right side of your screen, when the tariff news became less bad, the market made a stand near a logical area. This tells us the stock market bulls were willing to step in and defend the uptrend that began in late 2022 when the S&P 500 bottomed in October. The NASDAQ bottomed in late December. Everything that we said about the NASDAQ composite also applies to the NASDAQ 100. The red line is anchored to the day the NASDAQ 100 bottomed in late 2023. You can see the market made a stand in that general vicinity near the October 2023 low, and we came back again and tagged that same red line and held. So if the market decides to backtrack, on all these charts, we have reference points below areas of possible support. In terms of market psychology in this region here in 2022, the reason why the bears overwhelm the bulls at these points of resistance is the net aggregate opinion of all market participants regarding all subjects on all time frames is still concerned. Whatever's bothering the market, the primary problems in this region here, the net aggregate opinion still believes it's a problem. That's not the case in this region here, where a decision is made to step up and buy and defend the uptrend. Thus far, we can say the same thing in 2025. The net aggregate opinion of all market participants regarding all subjects on all time frames at this point had the conviction, the bulls overriding the bears, to step up and defend the uptrend. As long as the S&P 500 remains above the blue and orange lines, from a probability perspective, the trend that began in October of 2022 and was defended again in October of 2023 remains intact. A similar and constructive picture with the Dow Jones Industrial Average. This 5-minute chart of the S&P 500 as of Thursday's close can be helpful to us if the market decides to backtrack. If we were to draw an upward sloping trend line from this region down here, we'll probably end up in this region here. Thus, after 8 consecutive days of gains, if the market decides to take a break, between 5,600 and 5,300, it's relatively easy to remain patient while giving the rally attempt off the early April low the benefit of the doubt. It's a good sign that the S&P 500 on the 5-minute chart could overtake all of these colored lines. You can see in March we were unable to clear this orange line. We were unable to clear the blue line here in early April. We've cleared both in early May. If you pause your video player, the S&P 500 is in the bottom panel. You can see the broad value line geometric index made a stand at an extremely logical level, very, very similar to the risk-on period after the correction in 2023 and near the major low in 2022. Similar situation when we look at a diversified basket of bonds, AGG in the ETF world, relative to the S&P 500 or SPY. The S&P 500 bottom panel down here, you can see where we had the major low in 2022. If we tie the ratio with the AWOP lines to those points, the region in here where the S&P 500 is bottoming, you can see we came right back to that level. And then when the tariff news became less bad, we reversed near a logical area. It's hard to make the argument that market participants believe we're about to go into a deflationary bear market and or deflationary recession as long as this ratio remains below the colored lines. Our interpretation would shift if the ratio can get out into this region here. But as we all know, we trade the chart in front of us. We'll see how it unfolds. AIQ relative to SPY still has a constructive look relative to the rally attempt off of the low in 2022. You can see we held near the purple and blue lines here, came back into a similar region recently, and thus far we've held. It would be encouraging if we could stay above this orange line here and then go on and see the ratio print a higher high above this level here. AMLP Master Limited Partnerships relative to SPY reverses in this region here just as the S&P 500 is bottoming. Similar situation when the correction ends in October of 2022. We have a similar look in the present day, and it coincides with the recent low in the S&P 500. ARKF is one of the leaders of the rally that dates back to late 2022, early 2023. The ARK FinTech Innovation ETF. It's common to tie the anchored volume weighted average price lines to previous highs and lows. You can see we held in this region here in July of 2024. We came back to those same lines and thus far have held. It's also constructive that we've retaken the dotted line, the anchored volume weighted average price line, tied to this pre-2022 bear market high that occurred in 2021. This is where the bear market in the S&P 500 took off in 2022. As we noted last week, it was a good sign that BKLN leveraged loans was able to clear the downward sloping trend line. If the stock market decides to pull back after 8 days of consecutive gains, this downward sloping trend line, this orange line, and this blue line are areas of potential support. The orange line is tied to early 2023 when tech and growth started to outperform again, following the Nasdaq's low in December of 2022. Like many of the other charts that we've covered, this ratio of dividend stocks to the S&P 500 reversed right at the orange line. The longer below, the more relevant it becomes. S&P 500 bottoms on Christmas Eve of 2018. We anchor the orange line in the ratio of foreign value stocks to the S&P 500 to that date. We came up to the same basic region, that line, when the S&P 500 made a stand near the correction low in 2022, early 2023. Came back up to the same line and tagged it, and thus far have been rejected in a similar manner to this point here and this point here. You can see if we draw a horizontal line from this 2022 peak in FTech, the Fidelity Information Technology Index ETF, that's almost exactly where the market bottomed over here in early April of 2025. We also made a stand near logical areas, the orange and blue lines. Stage 2 of the secular bull market in stocks began in 2013 when we cleared the highs from the year 2000 and the S&P 500's high from October of 2007. That would be this region here. If we anchor lines to the ratio of gold to the S&P 500, that's almost exactly where the COVID low was made in 2022. The S&P 500's on the bottom. We came right back up to that same pair of lines, the black and purple line, and thus far, it's acted as resistance. Similar situation in this region here, the ratio of IEI 3 to 7-year treasuries relative to the S&P 500. The blue line is anchored right where the S&P 500 made the major bottom in October of 2022. The NASDAQ bottoms in this region here, came back up here. This is where the correction in the S&P 500 ended. Near the 3 lines, we came back up to those same 3 lines, and you can see we have reversed sharply since the S&P 500 made a low in early April and the tariff news became less bad. This ratio has now made a lower high and a lower low since being rejected when the S&P 500 bottomed. This is where the bear market in the S&P 500 starts here in January of 2022. If we anchor lines to IUSG growth relative to SPY, you can see those lines acted as resistance during the bear market here, resistance here. Once again, market participants were saying whatever was bothering them, primarily interest rates, Fed policy, and inflation in 2022, was still bothering them in these areas. That started to shift in here. We're still trying to flip, but notice how long the ratio on the right side of the chart has been above the AWOP lines. That's a good sign. We bounced near a logical area. If we can go on to print a higher high above this region here, confidence would increase. You may need to pause your video player here, but this is easy to understand. The trend of growth stocks outperforming the S&P 500 began in this window here between 2013 down here and 2016. You can make an argument that we've come right back to that upward sloping trend line in the present day, and we bounce near a very logical area. You can also make an argument that policymakers in the United States and around the globe have made our job as investors much, much harder in recent years. They have skewed this ratio tremendously by printing money, running the printing presses 24/7 in the COVID region here, and overstimulating. Then in this region here in late 2021, the Fed signals that they're going to slam on the brakes, then they shifted into reverse and floored it, raising interest rates several times and once again significantly distorting the market's price mechanism. You can see we went above trend here, below trend here, and we're back to what appears to be that trend, and we're trying to make a stand. It's also logical that we're doing so above all of these important AWOP lines. The longer this chart can maintain this look, the more meaningful it becomes. Once again, think about how long this ratio has been above this region down here. So far, we've come back and tagged it and tested it here and here, and so far we've held. Now we're looking at IVE value stocks relative to XLK tech. When the market was concerned about inflation in 2022, you can see value stocks in this region here significantly outperformed. You can see the ratio is rising in this region here. And then right after the NASDAQ bottoms here in late 2022, that ratio reverses. And instead of having the lines act as support, they start to act as resistance. All of these lines tied to important areas. Again, this reversal here, here's the bear market, the end of the bear market here. We came right back into that region, and just as the news cycle flipped on the tariffs and became less bad, this ratio reversed sharply near that logical band and has gone on to print a lower low. Our interpretation of the probabilities and our interpretation of this chart would change if price can get out into this region here. That may happen very, very soon, and it hasn't happened yet. Very similar concepts here. Growth, IVW relative to SPY, the S&P 500. During the bear market in 2022, you can see the ratio plunged as market participants were concerned about inflation, interest rates, and Fed policy. This ratio reversed sharply as the NASDAQ was bottoming and right after the S&P 500 bottomed. The convergence of these lines tells us that this region in here is extremely important. And once again, look how long the ratio of growth to the S&P 500 has been trading above the lines. The same lines that acted as resistance during the bear market in 2022. This is the transition period in this window here. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. This tells you a lot about inflation expectations relative to inflation expectations in late 2021, early 2022. This is the ratio of IWF relative to IWD that we've covered in various forms for quite some time. It is broad growth stocks relative to broad value stocks. These important AWOP lines that are tied to this region in here in May of 2023, where the market really flipped into risk-on mode and tech and growth started to lead, we have come back and tested the green and purple lines, and thus far we've held and we've gone on to exceed this high here and this high here in the ratio. We're also trying to recapture the dotted horizontal lines that acted as resistance near this high in 2021 and resistance here near this high in 2020. Once again, it is noteworthy that this ratio has traded above all of these colored lines, the upward sloping lines, for the vast majority of the time dating back to early 2023. And even if the market decides to backtrack, we've got several reference points in this region here below price or below the ratio. This is early 2022 here. You can see the ratio is rising rapidly. This is energy stocks relative to SPY. As fear of inflation, rising interest rates, and Fed policy are dominating the market during the bear market in 2022. You can see the present day in terms of concerns about inflation on this ratio pale in comparison. The ratio of financial stocks relative to tech stocks, Christmas Eve 2018 down in this region. Here, the S&P 500 bottoms, the ratio is rejected here. Come back up to those same lines as the stock market is bottoming in 2022. And we've come back and tested those same lines, and thus far, they have once again acted as resistance, similar to this region in here, and similar to this region in here. The ratio of S&P 100 stocks to XLK, the technology sector for the S&P 500, both ETFs, OEF relative to XLK. This drop in the ratio here coincides with the bottoming process in early 2019, late 2018. Similar situation over here near that major low in 2022. The ratio of OEF to XLK comes up to the same lines, and the ratio is rejected and starts to move away. Thus far, we have a similar look in 2025. RSPT, the equal weight S&P 500 ETF, has come back and overshot this region here that acted as resistance in December 2021 before the 2022 bear market. We have now recaptured that level after bouncing near the logical regions of the blue line and the orange line. The fact that the market made a stand, or the ETF made a stand, RSPT, near those two lines in October of 2023, at the end of the S&P 500's correction, tells us that until proven otherwise, the bounce at the same two lines says the default story right now is the uptrend off of this low in October of 2022 is still in place. Remember, when you're using anchored volume-weighted average price lines, or AWAP lines, when you're looking at ratios, it typically makes sense to anchor them to major highs and major lows. That applies to ratios as well. The ratio of 1 month to 1 year treasuries relative to SPY, that ratio was rising during the bear market in this window here in 2022. If we anchored to the point where the S&P 500 peaks, and then we anchored to the point here where the S&P 500 bottoms in mid to early October of 2022, and then we anchor again to the point where the correction ends in October of 2023, you can see in the present day we've come right back up to those same two lines. We've reversed, we've made a lower high and now a lower low. You can make an argument that this point here looks similar to this region in here. SPHQ, high quality S&P 500 stocks, it's an ETF relative to XLK. The ratio starts to fall in here near that Christmas Eve 2018 low. The ratio gets rejected near a logical area, just as the NASDAQ Composite and the NASDAQ 100 are bottoming in late 2022. We've come right back up to those same two lines and thus far have been rejected in a returning to risk-on attempt manner. Covered this chart last week. SPYG growth has thus far made a stand at a very logical level. It came right down here on the right side of your screen, what once acted as resistance as SPYG was peaking in late 2021, early 2022. On the left side of your screen may now act as support. It previously acted as a stall area in here, telling us that that dotted line is most likely an important region. We also made a stand above all three of the rising colored AWAP lines tied to relevant regions in SPYG. The tariff news became less bad in early April 2025 at another logical region. The 50% retracement of this entire rally off of the October 2022 low, this would be point A down here, this would be point B up here in early 2025. This is the 50% level here. When these lines converge, they're telling us to pay close attention. Notice during the bear market in 2022, the ratio is below the lines, and for the most part, their slopes are rolling over or down. If we look back several months, the vast majority of that window features the ratio not below the lines, but back above them. If the market decides to backtrack, keep in mind that overshoots are not uncommon, this region here. So if this ratio moved into this area here, that would be concerning, but a short stay like this would not be overly concerning. Given everything that we've covered recently, if you pause your video player, the ratio of SPYG growth stocks to SPYV value stocks, it's probably fair to say the present day really doesn't look anything like the bear market in 2022, and we have a constructive trying to flip the trend look in 2025. SPYG growth relative to VU. This is a daily chart tied to the peak before the bear market here, tied to the bottom where the bear market is ending in late 2022, early 2023. Look how tight the two lines are, and look how long we've been above the lines. Compare and contrast that to how long we were below the orange line during the bear market. It would be a very good sign if we can hold these lines, and remember, overshoots are common, and if we can go on to print a higher high in here, that's what the stock market bulls want to see in the coming weeks and months. It is also possible that this consolidation period, or this period of confusion, could continue. Right now, this is a consolidation box in here. USMV minimum volatility relative to SPY, the ratio reverses just as the major low is being made at the bottom panel here in the S&P 500. It also reverses near a logical area as the S&P 500 and NASDAQ are making a major low here in 2022. We've come right back to the same general region, the same general reference points, and thus far have been rejected just as the tariff headlines became less bad. Covered this chart last week. This is VFH relative to defensive-oriented SP low volatility. Financials relative to defensive SPLV in the ETF world. We are still holding the 8-year breakout. This looks like a bullish breakout, upper right-hand corner of your screen, and thus far a retest. If the market, the S&P 500, decides to backtrack, there are several areas below this ratio that could act as potential support. Communication Services XLC relative to SP low volatility, defensive SPLV in the ETF world. January of 2022, the ratio slashes through 1, 2, 3, 4 AWOP lines. Really doesn't even bounce in this region here. That's not what we have thus far in the present day. In fact, the look that we have as of May 1st is this trend off of the low here in late 2022, early 2023 is still intact. The buying conviction in XLC relative to SPY has allowed the ratio to clear all of these areas of potential resistance in here and get into the white space area. If this reverses sharply, that would be concerning. That will be like a failed bullish breakout. But if we can stay in this white region here, or even backtrack and stay above the red line, tells us to keep an open mind about XLC resuming the uptrend that started back here in 2009. January of 2022, this is Energy XLE divided by IEF, 7 to 10 year Treasury bonds. This is what increasing fears about inflation look like as the ratio starts to rise rapidly in Q1 of 2022. We really don't have anything like that in the present day. Thus, this ratio doesn't really seem to align with the narrative going around that tariffs are going to cause inflation. This is XLK, the tech sector in isolation. What does this look like? This looks like an ETF that got very extended from the trend in here. Now it looks like it's come back to the trend. It tagged the upward sloping anchored volume weighted average price line tied to the major low that was made back here in October of 2022 and held exactly at that line. What does that tell us? It tells us that investors in XLK decided to defend the trend here. If we change this to a high-low close bar chart showing the daily ranges and put a horizontal line in here exactly on the day of the peak here in late December 2021 over here, you can see the market came down basically to the exact same area on the right side of your screen over here and held. What once acted as resistance on the left side of the screen in late 2021 may now act as support, and thus far has acted as support. The last thing XLY did in isolation was make an important higher high in here in late 2024. Right now, the uptrend off of this low here in 2022 is still intact. If the market decides to backtrack, we have several areas of potential support in this region here. These are good reference points. We've covered numerous charts in this week's video because we're taking a weight of the evidence approach. Do the charts that we just covered align with or contradict the recent flurry of positive signals and data points? And another relevant question, the charts that we just covered, do they align with or contradict the thesis that we're in a secular bull market primarily driven by demographics? And we all know, regardless of what happens next, the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.